Hello traders, this is Joanne with Succeed in Forex. Welcome to our Forex Market News broadcast for Monday, February the 4th, 2008. The headlines today out of Switzerland focus mostly on last week's economic data. The headlines read, payrolls heavily disappoint, dollar hit but rebounds. The non-farm payroll report announced on Friday brought disappointing news for the U.S. dollar. Payrolls declined 17,000 versus market consensus of a 70,000 gain. The unemployment rate actually decreased to 4.9% from 5%. The University of Michigan sentiment report fell to 78.4 in January versus the 79 that was expected. The construction index fell by 1.1%. On the contrary, however, the ISM manufacturing index came out better than expected at 50.7, beating the expected 47.3. Some economists argue that these numbers point to a U.S. recession, while others disagree but maintain that these numbers must improve in the coming months for the U.S. to steer clear of a recession. The UK manufacturing PMI hit 50.6, far below the market consensus at 52.5. Output prices, however, have been climbing to new highs, and the Bank of England might now be more concerned about the economic growth rather than inflation. From this hypothesis, we might expect the British pound, which was the only currency to fall against the dollar at the release of the U.S. payroll report, to remain under pressure, particularly against the U.S. dollar. Looking closer at the Asian session, we were concerned that the European central banks were cool in face of the Fed's action. And it seemed that they were still in uncharted territory, even after Friday's non-farm payroll figures. The U.S. equity market progressed, although the fear of a protracted recession is still unflinching. This is underlined by the ISM manufacturing index, which despite its rebound does not dispel fears of an impending consumer-led recession. On the other side of the pond, it appears that the European and British central banks will not follow the Fed in its aggressive stance. Their outlook on the future is still very much determined by an eruption of inflation. There is plenty of data pointing to a slowdown of economic activity, yet there is still reason to believe that the ECB will refrain from cutting their key rate from 4%. The Bank of England's Monetary Policy Committee is likely to lower its key rate on Thursday, possibly 0.25% to 5.25. The dichotomy in this reaction is principally because of the different mandates the various central banks have put on themselves. The Fed is concerned, simultaneously, to maintain growth and check inflation, while the ECB and the Bank of England both focus more, although in varying degrees, on inflation. The recent drive in commodity prices has therefore grabbed Trichet's attention more than it has Bernanke's. We are not to expect Trichet to douse his tone on inflation, as the German public workers demand 8% more on their wages, and joined together with the energy and transport workers, were opposed to strike on Friday in anticipation of the wage talks. Governor Mervyn King, on the other hand, of the Bank of England, has to battle the bleak view of the UK manufacturing managers. That being said, there are still fears that the price they will propose will rise. Markets on a whole are expecting 5 rate cuts this year, but the consensus, considering the market conditions, is only 3. Mr. King has a record of resisting rate cuts. His new 5-year tenure will definitely be marked by many battles on this front. All this will provide much fodder for the central bank's meeting in Japan this coming Saturday. The European session was mostly focused around the European Central Bank's worrying about inflation. It is widely expected that the Bank of England will cut rates on Thursday to 5.25. However, it is also widely accepted view that the ECB will hold its rates unchanged after the Eurozone inflation rates rose to 3.2% for January. The markets are clearly of the view that the Bank of England could ease further to 450. But this week's data clearly shows that this aggressive stance by the bank could be overdone. Data in the UK, especially the PMI survey, is expected to be at their lowest ebb since the attacks of the World Trade Center. Nonetheless, there are still conflicting signals as to the pressure there could be put on the input and output prices, which may stay Governor King's hand. ECB's Trichet will not need much to underline the risk of a growing inflation pressure, but the ECB will need clear signals of a real deterioration in the data to force its hand at easing rates. Wednesday's German data will not help those asking for a rate cut. Although the German factory orders for December is expected to slow, the German industrial production, due Friday, is projected to increase from 3.5% to 4.1%. That concludes our news for today. We hope that this is beneficial to your trading and that you will join us again for our Forex market news report. Before we sign off, we would like to invite you to check out our website at www.succeedinforex.com. There you can find a link to our Yahoo form, which is also Succeed in Forex. On our website, you can also find information about our Traders Training Center, where our motto is Traders Helping Traders Succeed in Forex. We will return tomorrow with another forecast, and we hope you can join us then. Until then, have a great trading day and happy pipping.